Hello and welcome back. Today I'll be going through my money management plan to be fabulously rich so that I can play video games all day long. I'll be covering my strategies and thoughts going into this, the strategy that even Warren Buffett used to build his wealth. I'll walk through each component step by step, sharing insights I have gained through years of experience in going through it all. Let's dive into the specifics of how I plan to achieve this financial milestone. The first in managing money is where it's coming from. That's my active income. My main source of active income comes from my day job as an analyst in a tech company. But I'm working in a third world country where the salary range is shit compared to first world salary. While the income is good enough relative to the local population, it's obviously not enough on its own to realistically reach a net worth of $1 million. This is where my second active income stream becomes crucial, which is day trading. Over the last decade, and especially the last few years, I have spent thousands of hours studying, backtesting, and forward testing various day trading strategies across different markets and asset classes. After lots of trial and error and blown up accounts early on, I have arrived at a trading strategy that's more suitable to my personality. Essentially, my strategy revolves around the smart money concepts, and you may also know it as the ICT concepts. I identify a higher time frame point of interest by mapping out FVG or order block and seeking confluences with volume profile at the same time. And then I'll be waiting for a market structure break of the higher time frame point of interest alongside execution in the macro time. My entry and exit will be based on the optimal trade entry model and the Fibonacci extension. I have mechanized my approach to the point that I usually set my profit target at a 6.7 risk to reward ratio each time. Confused? Well, I'll be creating a video on smart money concepts once I have the time. I use this edge primarily in the index futures markets like ES or NQ. I'll be taking trades with extremely tight risk management. My average risk per trade for now is around $200 per trade because I am still trying to accumulate prop firms funded accounts. My day job salary will go into buying prop firm challenges, and I'll be using these prop firms accounts as leverage to secure more payouts than I would usually do with my own personal trading account. With the active income covered, let's discuss how I allocate and manage the cash flows coming in from all this active income. The first allocation that comes off the top are the mandatory costs like taxes and living expenses. I also have a mortgage to pay, so that takes out a large chunk of my day job income. For living expenses, actually, I'm a fairly simple guy. I eat roughly the same thing every day, and my grocery, transportation, and other essential costs are almost the same. So my expenses are fairly fixed. I don't know if I said this before, but my father actually borrowed a lot to invest in the 90s, but he lost it all. My parents spent the next 30 years trying to pay off the debt. So growing up, I'm actually quite afraid of the word debt and live a frugal lifestyle. The habits and fear never left though, even though I'm much older now and have a fair bit of cash to spare. I will not go into the credit card debt and will pay off most of my other debts. But you might say, if I dislike debt that much, why do I have a mortgage to pay then? Well, it wasn't really my idea. Frankly, I'm satisfied with renting only. But my mom's idea of investment is always property, especially if I'm gonna stay in one. Basically, my mom nags a lot if you don't follow her idea, and I bought one in the end. But how I would approach paying off my debt is that if it's more than 5 or 6% of interest, I will pay it off first. I know I could get more if I invested in the stock market with perhaps the annualized return of 7%. But the thing is, the returns of the stock market is not consistent. I would rather eliminate the interest bearing debt first. I am also maxing out on my employee sponsored retire account, which is equivalent to the 401k, taking advantage of the employer's match and putting pre-tax income into low cost index fund each year. This provides me with a tax advantage growth over the long run. My next bucket of money where the money goes to is to my emergency fund or my FU fund. Having a solid emergency fund is critical to me both financially and psychologically. My target is to have enough cash reserves to cover 6 to 9 months of my total annual spending. I keep this fund in a high yield savings account, and the opportunity cost of not investing this money for me is well worth the peace of mind. If any major unexpected costs pop up or I lose my job for whatever reasons, I'm covered for half a year without having to eat into my investment income. I didn't always have such a large cash buffer for this, but by living well below my means and consistently directing money towards this reserve, I have built it up over time. Having a fully funded emergency fund gives me the ultimate option to quit my day job and go full-time into trading and investing without being forced into desperation mode if I needed to. With those core bases covered, we can get into the investing particulars and how I plan to truly multiply my wealth this year and beyond. I have two categories for investment, which is the passive approach and the semi-passive approach. The first investing bucket is dedicated to long-term passive index fund holding. I'll be honest and admit that I no longer have much of any buy and hold approach to stock. It's not that it's a terrible approach. I still recommend this for beginners who wanted to start investing and knew nothing much about the stock market. But for me, the real wealth compounding comes from the second semi-passive strategy, utilizing options and leverage in a risk management way. I utilize a consistent wheel strategy across a portfolio of around 10 to 15 stocks that meet my fundamental criteria. These are primarily large caps tech, consumer, industrial, and healthcare names with solid financials and growth prospects. The wheel strategy revolves around generating income from option premiums through the different options construct. I'll first start off by selling cash secured puts, and I'll keep selling it until I got assigned with the stocks. Once I got assigned with the stocks, I will sell covered calls through it until the stocks is sold off. And then I'll start back again with selling cash secured puts. So this is a cycle that keeps on going round and round. Call and put options are financial contracts that give the holder the right to buy or sell shares of the underlying security at a specific price by an expiration date. Each option will control 100 shares of underlying stock. The start of the wheel strategy is to sell cash secured puts. It's an option selling strategy where I receive a premium for agreeing to buy a stock at a lower price. I will need to have enough cash to buy the stock if the put option is assigned, meaning if the price is lower than the strike price at the expiration date. People buy put option because they expect the price of the underlying stock to go further down. They pay a premium for the time period for this trade to work. As a put seller, I receive the premium and is counting on the theta decay or time that the trade won't happen. Think of it as an insurance. The put seller is the insurer. I will sell you an insurance that the price of stock A won't be lower than the strike price at a future date. You will pay me the insurance premium for being the insurer. At the future date, we will look at the market price of stock A. If it's lower than the strike price, I will buy stock A from you at the higher strike price, and I got assigned. Otherwise, nothing happened and I get to keep your premium. To enter a new position, I will identify an area where I would want to own shares of the company at a discount to the current market price. It needs to be a stock you are willing to hold because you can get assigned to it. I will then sell cash secured puts at the lower strike price, collecting premiums upfront. For example, if Apple is trading at $160 and I would be willing to buy the shares at $150, I can sell a put option at $150 strike price and collect $3 in premium. This will give me a $300 credit for every contract sold because each option controls 100 shares of the underlying stocks. If Apple stays above $150 by expiration, I get to keep the full $300 premium for essentially getting paid to re-evaluate whether I still want to buy the stock or not. This lowered my cost basis if I do get assigned shares. If Apple dropped below $150, I'm obligated to buy 100 shares per contract at my $150 strike price. But since my effective cost is reduced by the put premium, I have locked in a great entry point versus chasing the stock higher. Do keep in mind that I prefer to stay in the selling put position because if I get assigned and the current market price is too low below the strike price, I can be a back holder. If I do get assigned shares from the cash secure puts, I will then transition into selling covered call options against that stock position. This generates additional income by collecting premiums from traders looking for upside exposure. It's an option selling strategy where I receive a premium for agreeing to sell a stock at a higher price. This time, the covered call seller is the insurer. I'll sell you an insurance that the price of stock A won't be higher than the strike price at a future date. You will pay me the insurance premium for being the insurer. At the future date, we will look at the market price of stock A. If it is higher than the strike price, I will sell you the stock A at the lower strike price. I will get the premium and some capital gain. Otherwise, nothing happened and I get to keep your premium. Continuing with the Apple example, if I owned the shares at the $150 cost basis, I could sell a slightly out of money $165 strike call, collecting another $2 in premium credit per share. There are two potential outcomes, assuming the stock did not get assigned in the middle. If Apple stays below $165 at expiration, I can keep the full $200 premium per contract. If Apple rallies above $165, I am obligated to sell my shares at that $165 strike. Not a bad problem to have, considering I have already lowered my cost basis through the previous options strategy. Either way, I can simply re-enter the wheel and start the process over again, ideally at an even better cost basis thanks to the premiums collected. I'm relying on this to generate monthly predictable income because the wheels runs round and round. 2 to 3% each month is a conservative estimation. Now, here's the secret to making it all work.